already mentioned, it's the crypto assets. Yeah, we saw the consultation paper of on the regulatory views about crypto assets, but that's this cross-border payment issue is the most important issue. The most important issue. I shouldn't rank it, but it's a very important issue being discussed.
We are now more than 10 years past the financial crisis, and considerable improvements have been made in the areas of prudential capital, liquidity, resolution. While some of these reforms are still being implemented, such as the final Basel III package, I think we can all say that the financial system and the banks are safer and stronger than before the crisis. As the global standard setters are now turning to implementation, it's also a good time to take stock and to measure the impact of these reforms and to identify any unintended consequences. As such, the IF strongly supports the work by the G20 and the FSB focusing on evaluation, impact assessment, and on addressing market fragmentation. But there are also new and emerging topics, such as digital and sustainable finance, which can also provide opportunities and challenges for the financial sector. So in that context, I'm going to ask Brian, so now 10 years after the financial crisis, and also in your current role at the Basel Committee and as a former US Treasury official, how do you see the official sector in having achieved a right balance? Do you think that they've achieved a right balance between stability and growth?
First off, I have to say I'm not answering questions on behalf of the Basel Committee or the U.S. Treasury, so I'm answering them just in my own right. And the remarkable part about your question, probably, Martin, is that we're 10 years after the financial crisis, and we've just finished the major package of Basel III in the very recent past. In answering the question, did we get the pendulum in the right place? That's a very difficult question to always answer, and it's very difficult to calibrate. And particularly right now, when you talk about non-traditional risks, that it's harder to get the pendulum in the right place when the laws of gravity are continuing to change around you. But I can say, whether right or not right, on where the pendulum is, that we need to stop, I think, regulation and focus more on supervision. Let the rules bed themselves down and deal with the consequences before we start to play around with rule books again. And I think the industry has grown tired, and regulators, quite honestly, are tired as well. And we can't forget one very simple thing, that the Basel Committee on Banking Supervision is exactly that, the Basel Committee on Bank Supervision. It is not the Basel Committee on Bank Regulation. And I think we do need to remember that. And so as we focus on non-traditional risks, I think all of the standard setters, including the Basel Committee, are thinking about their remit, thinking about the areas that they need to focus. And one particular area, as mentioned, I co-chair what's called the Basel Consultative Group, which is how the Basel Committee reaches out to non-member countries. And there's one element that we're working on at the Basel Consultative Group which ties in directly, I think, with the G20 agenda of Saudi Arabia, and that's the issue of proportionality of regulation. And we're proposing kind of a novel idea, you could say, through the Basel Consultative Group, that Basel III compliance, if you want to call it that, is the standardized approach, not the advanced approach. And I think the market, in general, when you ask a country or you get feedback from a country, are you on Basel III, people assume that means the advanced approach. And I would rather turn that around for most of the world and say Basel III is the standardized approach, because that's what everyone should do. A country, based on its complexity and depth of its financial sector and its banking sector, could then go into the advanced approach as the exception. And that should be the exception, the advanced approach, not the standardized approach. And also, I think one of the issues that we need to focus on is there shouldn't be a penalty for putting together a set of rules that don't apply to the market that you're in. So the whole world spent huge amount of time, energy, and money on CVA, for instance, a great example. that doesn't really affect very many banks, and it doesn't affect some jurisdictions at all. And I remember back in my days of the OCC, when I was with the U.S. Treasury as the comptroller of the currency, that we had an examiner once who cited a bank for not complying with a specific law that said you had to have a branch closing policy. And the purpose of that law was that you weren't closing branches in low-income areas and damaging the community. So they cited the bank for not having this branch closing policy. And the bank came to me and says, we accept the fact that we're non-compliant, but we also don't have a branch. So the law didn't apply to this particular bank. And I think some of that we really have to think in some common sense terms along those lines as well. So, thank you.
Andreas, if I can ask you, I don't know if
This is working. This is working.
Yes, it's working,
yeah.
great. If I can ask you also for an assessment of the overall impact, and maybe you could touch a bit more also on the unintended consequences, to what extent you see them and how they can be addressed.
Now, first of all, thank you very much to the IAF for inviting me. It's a pleasure to be here. I agree with Brian that we should only have regulations and rules which make sense. And I'll talk a little bit about that where I think where it makes less sense than intended. But before you talk about unintended consequences, it may be important to take stock where we stand and then where we wanted to be and we didn't get. So first of all, pretty much as you said, I would agree that the main elements of this post-crisis G20 reforms have been implemented, but that does not mean that they are completed. Yeah, so implementation does not mean a completion. So we still need to complete those reforms. Then we need to evaluate them, and you can only evaluate them once they have been completed. And once you have evaluated them, then they need to be applied. And this all comes together. All these reforms, and I was part of the group of people who worked on those reforms, aim at making the financial sector more resilient. Therefore, it's important to see whether this aim is really achieved, and you have to benchmark yourself against the aim of whether the market has become more resilient. And that's why under the German G20 presidency in 2017, the Financial Stability Board actually was tasked to come up with a framework for post-implementation evaluation of these reform effects. So this is now going on for quite some time, and several projects have been started, and some of them have been finished, and some of them are still in the process. So 2 projects were especially concentrating on unintended consequences. One was the financing of small and medium enterprises, very much also a German topic, because the SME market is also not only but also a German topic, and that was, they looked at unintended consequences there. The other one was the financing of infrastructure. And from what I can tell, the result was that in most cases, the reforms work as intended. I'll come to my downsides in a second. There was a third working group, which is actually being discussed at the G20 while we are sitting here, and this is all about OTC derivatives and actually the central clearing of OTC derivatives. And in that case, the G20 have passed this on to this important topic on to the Basel Committee, and the Basel Committee, where we sat together for a long time, the Basel Committee is looking at it. There's one issue open, which is being discussed now, which is very important for the membership of the IAF, which is the too big to fail issue. Now, the too big to fail project will be there will be a consultation, I believe, in June of this year so not very far, and then we should have recommendations by the end of this year. So this is still ongoing, and unintended consequences could especially be there. Because if you think about the aim of making this a more resilient market, we have to look at the too big to fail, because that was at least at the outset of all these reforms, was at the center of it. So there has been, it's under the leadership of Claudia Buch of the Bundesbank, and there is an academic team being formed, and we will see what will come from here. Now, this year, in Saudi Arabia, at the G20, also at the Basel Committee, the entities are looking at new risks. And I think there are 4 categories of new risks I can see. The first one is, and it was already mentioned, it's the crypto assets. Yeah, we saw the consultation paper of on the regulatory views about crypto assets, but that's this cross-border payment issue is the most important issue. I shouldn't rank it, but it's a very important issue being discussed. The second major aspect is the outsourcing of financial technology, and this is mainly an artificial intelligence question that is being discussed. The third are all climate risks, which came up in yesterday's discussion with Kristalina at the dinner of the IIF, and on ESG in general and climate risk in particular. And fourth, and not least, the G20 and mostly the Basel Committee are looking again at market risk and especially at disclosure. So these are the 4 areas we are looking for, and in all of those cases, one has also to look at unintended consequences, but I would like to add a big but. It's not only about unintended consequences, but it's also about regulatory arbitrage. If market participants, through regulatory arbitrage, circumvent regulation, what kind of unintended consequence is that? So you have to differentiate unintended consequences from regulatory arbitrage. One of the major unintended consequences would be a market fragmentation. Yeah, that's not intended. The Basel Committee, as Brian and I know very well, is intended to put complex regulation on complex banks and not necessarily on every bank. So that's why I appreciate your comments on proportionality. But we have, very importantly, different standards with regard to data. We have different standards with regard to financial crime. We have different standards with regard to anti-money laundering. So there are quite some differences, and that's what needs to be pulled together, because that would be an unintended consequence, which has nothing to do with the aim of making this a more resilient banking market. It would actually lead to market fragmentation and make it a less resilient banking market. Let me stop there.
Great, thank you. Veronique, I'm working at a global bank. You obviously also see a much market fragmentation, right? So in all the countries where you operate, they're coming with different rules. And the FSB and IOSCO have over the last 2 years really prioritized market fragmentation. Can you explain to us a bit why market fragmentation is a problem and how it impacts firms like yours? Why should we care?
Thank you, Martin. Thank you to the IIF for having me in the panel. Indeed, we have very much welcomed this initiative by the FSB under Japanese G20 presidency to launch this work on market fragmentation. Market fragmentation, I'm happy to hear that it is not an intended consequences, but actually we heard from some at the FSB that it might be intended, in the sense that we are now supervised as a large international group with the view by host supervisors in particular of what could go wrong in a crisis, so very much in a mindset of resolution and trying to provide certainty to the way that a crisis situation might be resolved. That creates obviously a lot of friction costs for the banks. So in the course of learning the lessons of the crisis, apart from the regulatory agenda, there has been also a supervisory agenda on market fragmentation, by which supervisors have imposed increasing roles, whether we are talking about full pre-positioning of capital requirements, liquidity requirements, also TLAC, of course, total loss absorbency capacity, and also in the pure supervisory world, stress testing to local subsidiaries and a lot of constraints on the local governance. All this has translated into significant costs for the banks, and to an extent also the fact that banks are not able to manage their resources at the global level and allocate them to the entity that may be in need in case of an idiosyncratic shock is actually, you could argue, an issue also of financial stability, because all these capacities and resources are actually trapped in local entities. So we very much welcome this FSB work. We hope it is going to result in concrete progress. I think it would be very detrimental if there was no concrete recommendation, because clearly not making progress is often making a step backwards in the wrong direction, and it would be like encouraging maybe some of the host supervisors to continue to implement more ring fencing. So two more concrete ideas. One, on the branches, I think it would be really helpful if the FSB could reaffirm the importance of branches in banking groups, why they are valuable for banks, but also for the clients of the banks and for the markets in general, and avoid any additional liquidity, in particular requirements on branches. That's on the branches. And on the subsidiaries, making a step toward a reduced fragmentation, in particular by a collective and cooperative reduction in the TLAC, in the internal TLAC requirement, might be a way to remove a little bit of the ring fencing and create a buffer of capacity, of loss absorbency capacity at the group level that could be allocated where it would be needed in case of a crisis. All this obviously requires cooperation between the supervisors. Indeed, the BCBS is a group of supervisors more than regulators, so that is a move in the right direction, we believe. It means also information sharing between supervisors, between home and host supervisors, where often the banks are actually trapped in the situation of not being able to answer to a home supervisor or host supervisor, given data, given supervisory confidential information. So this is a very important topic, and we hope that the report of the FSB will help making progress.
And would you see a role for the colleges in trying to address fragmentation?
The role of the colleges, yes, of course, they are there to be efficient. We only have partial visibility, and rightly so, in the way they work. But definitely, this has been created as a place for host supervisors to understand better the overall structure and the overall business models of the groups, and therefore they certainly could play a role. And of course, we also we are in a situation. Most of the GSIBs in the world are actually single point of entry, yeah. And therefore this concept that banks should be supervised and have their loss capacity at the global level makes a lot of sense from that financial stability perspective.
Great, thank you. Jose Manuel, BBVA is known as a leader in innovation, and I was wondering if you could touch a bit also in a regulatory context on what the opportunities are for innovation and technology.
I think that the main, first of all, thank you for the invitation. It's really an honor to be here. And also let me say that now I'm co-chairing the Task Force on Finance and Infrastructure of the B20, and to some extent I will reflect some of our discussions in the context of this task force. I think that the banking system has been, to traditionally one of the sectors that has used technology to the fullest. So technology is not really a new thing for banking. But what we are seeing now is not just technology change, is a fully fledged revolution that is generating potentially many benefits to society in terms of inclusion, in terms of, say, democratization of finance, think of wealth management, for instance. Also benefits for clients. Really the client is a powerful element now. So being client-centric is not an option, is the only alternative to survive in this business. Also, this brings lower prices, more variety, and for the business, it means potentially also reduction of cost. But with all these benefits for society and for clients and individuals, we have to confront a few elements connected to regulation that would make, I think, competition and also fulfilling the mandate of financial authorities, I think, more to the point. And let me refer to three things very briefly. One is the role of big techs in all this context. Second, regulation slash access to data. And third, of course, the need for some kind of global regulation impacting things that are truly global these days, including cybersecurity, data, and all that. So on big techs, you know, there was a lot of hype a few years ago about fintechs. Fintechs are going to kill the banks. Why do we need banks? We need finance, of course, and this can be done by these small entities that appear in some garage somewhere, focusing very much on a vertical, on a market segment. We have found out after some time that not many fintechs survive, and those with best ideas have great difficulty in growing because it's very costly to grow and to capture a market share. So at the moment, banks don't see fintechs as a threat, but more as a potential benefit if you liaise with them through in many ways. You can outsource some activity to them. You can bring them in to fertilize areas in an incubator model. You can partner with them. You can invest in them. And those make the banks better and they can survive. But the issue with big techs is different. Because big techs are there because they have been extremely good at managing data in a world where access and management of data was not regulated. They also have profited from network economies, and they are acting these days, and this is not so nice, as gatekeepers. So if you go through the gate, you can access some services, otherwise you don't. So on the one hand, positive thing is that they create a very good user experience. On the other hand, they can create potentially problems that are of interest to authorities. First, financial stability issues. You cannot say they are small, and you cannot focus only on the leverage they have in order to think of potential scenarios where operational risks impinge on the whole financial system. So financial stability is an issue with big techs. Profitability, of course. If they go in with a totally different regulation or no regulation at all, you may find that they become quickly prominent in the credit domain, impinging on the profits of the incumbents for consequences that cannot be at the moment assessed. In the front of a totally different domain, which is competition, of course there are many issues that appear as well. Because as the FSB has said recently, a small number of big tech firms may in the future come to dominate rather than diversify the provision of certain financial services. So they could create potentially a situation of oligopoly that we don't have today with the banking system. There are other risks, of course, integrity. So think of AML, CTF, and all the discussion around the creation of Libra. One of the issues was, okay, how do you guarantee me that these operations are clean? And it turned out that there was not a very reassuring scheme to fight anti-money or to do anti-money laundering, CTF prevention. So this is the first thing. The second thing is level playing field in connection to access, with access to data. You know, the model of open banking is imposing itself, and that's a very good thing. I think it creates competition, it works to the benefit of clients, so nothing to question about that. I'm not criticizing the open banking model, but what can be criticized is the asymmetry that you face with potential competitors when you are subject to data portability constraints and to use APIs in order to facilitate third parties operating on behalf of clients, whilst this is not the same with potential competitors. So in order to realize in full the benefits of data protection and open banking, I think this standard should be extended across sectors. So if one client of a banking institution would ask Google, please give BBVA all my data because I rely on these guys, they should be forced to do that in a standardized way. And this is not the reality these days. When there are asymmetries, you create potentially problems with huge implications also for financial stability. So I think this rationale should be extended for the benefit of clients, full competition. This would unlock a lot of competitive forces and maybe create a new wave of competition to the benefit of clients. But of course, all these things have to be thought of globally, because digital is not a local thing. And financial authorities traditionally have been concerned regulating locally and for the financial sector. But now we are thinking globally, and think that the bad guys, the cyber attackers are global. It is not that the national guy can be prevented to do things in another place. Data issues are global by definition. So there is at the moment not international financial institution has a mandate to go through all these things. So I think this is a matter to think twice or even 3 times, because the sooner we tackle them, the better. It looks like the authorities are, of course, studying this, the FSB, IOSCO, Basel Committee, and all those bodies, but not until there is a real threat, like it happened with the Libra. They react swiftly in order to produce guidelines. So let's, I think, think in earnest about bringing solutions to the problems they pointed out.
Yeah. Yes, but if you're looking for supervision and possibly rules across sectors, would the FSB be the right place for that, or would you think of a new sort of supervisory framework?
I think the FSB is quite well located to the extent that it connects well with G20.
Yeah.
To that extent, the sample of countries, I don't know how to deal with this. It's belts and suspenders, but not enough. So I would say yes. In one word, if we would be able to set up an ad hoc task force to deal with matters like digital competition, discrimination and social exclusion, data control, data theft, fake news and manipulation, all those things that are truly global, I think we would be in a better place.
Thank you. Andreas.
And we do have enough bodies, international bodies. You know,
Yes.
we are not short of international bodies. You know, we rather get rid of some of them than having even more. Yeah, it's already quite confusing.
Yes, I also wanted to ask you about recovery and resolution. You mentioned TF in your last answer. Banks have issued lots of TLAC. They have recovery and resolution programs. The question comes back, you know, are banks too big to fail? Why and why not? How do you see that? And also, what do you think the impact is of ring fencing measures like the IHC in the US and IPU in the EU on cross-border banks?
I think we all agree that banks need to be strong and resilient, and they need to be especially strong and resilient in the crisis. So that's what, you know, there's no controversy there. Now, with regard to TLAC, I would like to differentiate into the external and the internal TLAC. Now, let's start with the external TLAC. And I think that the progress has been steady, and the progress has been significant in both setting the external TLAC requirements by the authorities, but also the issuance of external TLAC by the G-SIBs. So I think we have good progress, and actually this progress is instrumental in enhancing the resolvability of GSIBs. I would not know how to do otherwise. Now that's the obvious answer, but I think there's some other important answers, because it is very important to have these requirements to strengthen the cooperation between home and host authorities. Because if you have that cooperation between home and host, and many countries can talk about that, go to Singapore, go to Hong Kong, and go to other entities, you are a step ahead. And it's also important to boost market confidence in the capabilities of the authorities to address too big to fail. If you don't have those requirements, this confidence may not be there and may not be enough, and the market may not be functioning. And this is why the evaluation of the Financial Stability Board and this task force, which is being led by Claudia Buch, is so important in this regard. So far about the external TLAC. Now, regarding the impact on cross-border banks, because this must be a big topic at the IAF, the internal TLAC requirements, the internal TLAC requirement is important to balance home and host interests. Why is that? Because host authorities are provided with sufficient confidence if there is enough TLAC, which then serves to prevent the ring fencing you just talked about. And we are having these tendencies of ring fencing. So there is a prevention for these ring fencing tendencies, while there is still, and where there still remains flexibility to ensure resources are readily available. This is why I believe we need to look at both the external and the internal TLAC requirements and how they work together in the home host environment.
Thank you. Brian, you're also a supervisor to both domestic and foreign banks. And so how do you look at the home host relationship?
We in the DIFC are purely a host supervisor, so we deal with a lot of homes. So of the 30 GSIBs around the world, we host 26 of them. Not all of them are there as a bank per se, but we host 26 of the 30, and we've successfully, in a 15-year period, climbed up to 8th place in the Global Financial Centers Index. And a large part of that is due to these banks that have set up in the DIFC. I think you have to, as a host, invest a lot of time to get this right with the home. That you can sign a memorandum of understanding when the bank sets up a license and your entity is the host, and that lays out all of the information sharing that's going to happen at any point in time. But if you wait until you need information before you have engaged the home, you're not going to get it at the end of the day. And so you have to invest in dealing with that home regulator and be proactive as a host in communicating with the home regulator. So we participate in a lot of supervisory colleges, and I think there's various forms of those supervisory colleges, but most of them work pretty well in terms of asking the right questions, getting the right answers, and making sure that you have a global view of the organization rather than simply a view of your sliver in the world. You know, and there's probably another aspect, I think, of, you know, when you start talking about too big to fail that we're dealing with right now around the world, and it's the opposite end. So when I represent emerging markets and non-member countries, that the phenomenon goes from too big to fail to too small to comply. And that's many of the jurisdictions that I work with are on that end of the spectrum, that they simply don't have the capacity to deal with a lot of the complexity. But nonetheless, as a host country, if you're going to host an institution, it's up to you to protect yourself. And that leads a little bit into the market fragmentation issue. And because we're mostly, or almost solely, a wholesale market, we don't have a safety net. But when you have a safety net in play, there will be a tendency to some fragmentation along the way, because deposit insurance rarely, if ever, crosses a border. And so if you have taxpayer money at risk for an entity in your jurisdiction, you will want some element of control. Now the TLAC requirements that Andres just mentioned is a good way to deal with that in a home host relationship, but you'll still have some element of protection that you want to apply.
Veronique, I wanted to come back to the finalization of the Basel III package. It's obviously going to start being implemented over the next couple of years in the EU, in the US, other places where you operate. I was wondering if you can talk a bit about what the impact you think will be of those new rules, and if there's any sort of unintended consequences that you think that could be seen there.
Yes, of course. So this finalization of Basel III, as you say, is well advanced in Europe, where there has already been an impact study and a full consultation, and we are now expecting in the coming few weeks and months the legislative proposal. So clearly Europe is quite committed to the implementation of this very important standard. You were saying there may be some too much time spent on capital markets activities on CVA. I would think that maybe you're right indeed, because when you look at the impact, most of the impact is actually on capital markets businesses, whether it is through FRTB, the new market risk framework, whether it is through the new standardized approach to counterparty credit risk, whether it is on CVA, and also the share of operational risk borne by market activities. I think we contributed to a very interesting study that the IIF led at the end of last year, which showed that although the capital markets businesses globally represent 12% of the total risk weights, they are actually attracting more than half of the increase in risk weight linked to what we continue to call Basel IV. So definitely this is an issue, and it is particularly an issue in terms of level playing field, because obviously those capital markets businesses are global businesses. This is an area where there is no reason at all to have any deviation, but that can only work if all the jurisdictions who have large capital market banks implement at the same time. So on this, clearly, the focus on implementation and coordinated implementation is absolutely essential. Essential in terms of timing, of course, because it can go very quickly. Banks can lose market share very quickly in such a market. And also coordination in terms of substance. And whenever there are some, I would say, over-calibrations or excessively conservative assumptions that are recognized in some jurisdictions and that translate into what the Basel Committee would call a deviation, maybe this should be brought back to the Basel level so that we can globally deviate or globally agree that maybe some of the parameters are not adequate. I'm thinking about SACCR, for example, where there has been a recent rule in the US with a significant change from the Basel standard. Clearly, we have lobbied for the same change in Europe, so we agree with our US colleagues, but at the end of the day, it should be at the level of the Basel Committee, and I think I'm not asking for an overhaul of a package which is just final, but some very specific adjustments would be extremely important to ensure this level playing field.
Thank you. Jose Manuel, I wanted to ask you about sustainability and green finance. There's been a lot of focus on that, obviously, today, yesterday, also at the G20. Can you talk a bit about how the banks are trying to come to grips with that from a regulatory perspective also, with the lexicon and taxonomy demands and things like that?
Okay, let me start by assuming that all agree on the fact that climate change is real and is human cost, which is not globally accepted, but I think in this community there should be no doubt about it. And the Paris Agreement was the point where it was decided to strengthen all efforts to limit the increase in global temperatures at the most 2% above pre-industrial levels, or even more than that, 1.5. Of course, when one looks at what this means for business, it is really breathtaking. I'm convinced that this is the largest, the biggest disruption to the business environment that humankind has ever faced, because we are looking at periods which are very short. There are, of course, many risks associated to climate change. Of course, if you do nothing or not quickly enough, you face so-called physical risks. So the increasing frequency of catastrophes or anomalies, as we used to know how the climate works, they are facing, of course, big impacts, not just the banking system, but also insurance companies and many others. If you decide to change, depending on how skillful you manage it, you will see technological risks emerging, legal risks, liability risks, risks of all kinds and nature. And of course, those will impact the cost of funding, among other things. So to add to the problems that were mentioned this morning, when you squeeze the margins of the business. Of course, there are many good news in the sense that now, I think, the main stakeholders are pushing in the same direction. You see consumers more and more aware of this, going to the branches asking you for green products. You see family offices there kind of telling you, okay, I only want green. So there are many Larry things to make the point very clear. Major companies are producing public pledges in that respect, even without having been forced by any regulator. They produce them right away. The banking sector, for instance, have signed, or many main actors, the principles for responsible banking. And my institution is one of the signatories, or the collective commitment to climate action, to align the banking activity to the Paris Agreement. Also investors, in particular institutional investors, have reacted strongly. Again, Larry Fink appears here. And finally, of course, public authorities are producing initiatives like the network of central banks and supervisors for greening the financial system, and so on and so forth. Where the opportunities for the banking sector are very relevant if one puts aside all these risks. For one, somebody has to channel these investments, which are huge. And I think the incumbents, the banking system now is in a position to do that. Secondly, the banking system now is pressed to develop products and services that are being demanded in increasing amounts by clients, individuals, but also corporates. Do you have a green deposit? Do you have a green loan? Do you have a green fund? And blah, and so on and so forth. And there is not enough supply here. And thirdly, of course, providing advisory and financial solutions to clients to help them go from brown to green. To implement this, we need regulators, and we need regulators to move as quickly as possible. In Europe, we already have a taxonomy since last December. It's just a European taxonomy that has the ambition to set, in a way, a template for a worldwide agreement, because Europe, okay, is 7% of the world population, maybe more of the GDP, but still is a minor part of the world. With the taxonomy, you have some specifics in order to make disclosures work, because taxonomies are there just to guide you in your action, but also to show to the public and to the world what you're doing in terms of where are you positioned from brown to green. And thirdly, on the basis of this taxonomy and disclosure, you can think of doing stress tests, not just the supervisors, but also the entities. You want to know what if this specific type of event would develop. Now there is a debate in some corners of the regulatory world on whether we should go for brown or green factors in prudential supervision. And I think this debate is a bit too early, because we don't have enough evidence in order to say these additional basis points for being brown or less basis points for being green. But I think say pillars 3 and 2 could work at this stage. So let's disclose things on the basis of a uniform and as harmonized as possible taxonomy. And only after we have enough information, let's think about green or brown factors in prudential supervision. I hope that going forward, the regulators and supervisors and the industry align their efforts, because there is no time to lose. Because as I said at the beginning, I think this is probably the biggest business disruption humankind has ever faced.
Thank you. So prudential capital standards should be based on the riskiness of the underlying asset. Andreas, when we look at global standards and why they're produced, why they're created, you know, it's for the world's largest banks, which can be very complicated, and very large financial markets. But they're also introduced in less sophisticated financial markets and for smaller banks. I was wondering how you look at the need for proportionality, and sort of in what ways can that be felt? In what ways can that be addressed?
Brian mentioned this issue already, and you're doing it again, I think for good reason, because I very much believe that banking has become very complex, and risks have become very complex. So we need complex regulation for the large cross-border banks in order to address those risks. This large complexity is not needed for less risky banks, smaller banks, less international banks with a different business model. So, the word proportionality is related to the riskiness of your business model. And this is why, as was mentioned before, the Basel Committee is suggesting standards for international cross-border complex banks, mainly for the GSIBs. We just talked about it, Brian. I think you said there were 8 US banks which are subject to the Basel rules. So very few, not the large amount we were having. In Europe, we went the other way, already in Basel II. In Europe, it was decided that whatever comes out of Basel is being put to the entire banking system. The idea was we need a level playing field. Even if you're a small bank, you are engaging in the same area of the large bank, and they are, you know. So we had a situation when I was still in office that my supervisors had to ask small banks to fill out pages and pages with blanks, and I needed people who checked that the blanks were filled out with zeros. You know, how silly, coming back to your branch example, how silly does it get? It's not efficient, it doesn't make any sense, it's wrong, it's simply wrong. So that's why I believe that in Europe we should really not have do the same mistake again, nor we should do that in other parts of the world, especially as the US, again, will only put these Basel standards on their large banks and not on their entire banking system, which is pretty much consolidated, so that we should have a proportional usage of those rules. There are some financial stability colleagues of mine who say, but that would be an issue because you do have herding effects. Even if there are a lot of small banks, they can go one way, and if they go all the same route, you know, these effects are increasing. I see that point, but nevertheless, you have to put the risk weights and the regulation proportionate to the risks. Every supervision is a risk-based supervision and should be, and that's why I very strongly believe that we should have a complex rule for complex banks and a lot less complex rules for less complex banks. And Brian mentioned the standardized approach as one of the as one of the principles.
So risk weights, standardized approaches, supervision can be less frequent or less onerous.
It
There
could be
yeah.
less frequent, you could have less reporting, you could have less reports to write, the amount of reports. For example, you are asked as a large bank to send in compensation reports. In medium-sized and small banks, those compensation reports may just not be necessary because those banks may not even incentivize their management by shares because they're not even listed. So you can do a lot of in the frequency, the amount of reporting. You can have also, of course, you could have different complexity levels, but you cannot really change the risk weights. The risk weight should stay the same. The liquidity rules, of course, need to stay the same. That is no doubt in my mind. But the overall frequency can be changed and can be adjusted to the amount of risk involved in those banks.
Consistent, yeah. Okay.
That is my opinion.
Jose Manuel, can I ask you, in the area of digital, what further work do you think is needed by authorities like the FSB and others to address things like data standards and geolocalization?
Well, as I mentioned before, instead of, and I think Andreas was to the point, creating a new body with a wide mandate, maybe FSB or the G20 itself would be the appropriate global institution in order to set up a list of priorities that have a global reach, including, of course, data standards, cybersecurity, the issues of fake news I mentioned before, and so on, in order to allocate responsibilities according to the decisions to different bodies that would have to coordinate among themselves. And the sooner the better, because it will be a very complicated thing, as we know. So we have a data standards in the European Union. We know that those are being implemented in the same fashion in some other parts of the world, but the pace is too slow for a good thing. But if there is a strong mandate with very specific deliverables from the G20 to the FSB to put this, I think, in motion, I think we can be hopeful that the current situation of fragmentation worldwide would be overcome. If not, we will see a lot of arbitrage. We will be emerging things that we don't like. And from the point of view of financial stability, if only financial stability, it would be very bad news for the system.
And we need to make sure that banks are treated the same way as non-banks which are competing with banks. So we have to make very, very clear that you cannot avoid anti-money laundering, cyber security, and all the other issues if you're just outside of the banking business, but involving yourself in the banking business. Otherwise, there is not a level playing field, which would be dramatically unfair and also not good. Then we would not have the competition you described earlier.
But then if I can complement what you say, we better start thinking about regulating financial institutions on an activity-based approach. And this is not easy. This is easier said than done. But the sooner we start, again, the better. If we do the same thing, we have to be treated equally, unless it is proven that the risk of the same activity is different because you are large or because you are global. Okay, but let's tackle that. Otherwise, if you regulate according to labels, according to names, you are in the wrong place.
I would disagree with that, but I usually always agree with Jose Manuel. I think we should stay with the risk-based,
this is what I said.
Activity-based. But risk-based is the basis, I personally think.
Maybe just adding one point on, I agree with what Jose Manuel said. One additional point is to, in this competition discussion, is to think about what is the value added of financial services. Is the value add in the provision of the financial services, which means that it has to be priced at a fair price to the customer, but has to be priced. And I would say the flip side of that is that the data is private and is controlled and kept safe by the banks. That has been the model of banks for probably as long as we can all remember. Or is the financial services a way to acquire data, and the value add is in selling the data? And of course, you cannot have those two types of animal compete in the same market.
That's right.
Either it's free or it has to be paying. I fear that in Europe currently there is around this concept of open banking a temptation to think that of course clients want things free, and it's true that the digital world has opened a lot of services that are apparently free and where you are the product, your data is the product. And so I don't know whether the banks should shift into that model, but clearly I don't think it is sustainable to have the two models coexist. One is going to win at some point.
Yeah, how do you see that, Brian?
Yeah, I mean, I do think, and I think it was mentioned earlier today, that technology has moved from what we thought of as purely disruptive 5 years ago, that all banks are just going to go away and be replaced by fintech providers, to something that's transformative. Yeah. I'm very happy to say that I think the financial industry is now paying attention to what the consumer wants and what the consumer needs in that overall customer experience journey. And many people want to wake up at midnight and make a transfer, you know, so let's let them do that. And I think we can move in that direction. But for the technology firms that come into our sandbox, I mean, we do ask them two questions immediately of how do you protect the consumers of your service, and how do you prevent financial crime? And if they can't answer those two questions, they have to go back and think some more and come into the spectrum. So I view fintech as transforming the financial services industry in a positive way. The threat to the financial industry, I think, relies more now on the big tech competition, and that's one that I view with interest. You know, I mean, probably how many people in the room right now have an Apple Watch on that has been paying attention to my heart rate and my movements and everything else all day, and probably knows that I had some M&Ms in the speakers lounge before I came out here. But Apple is very trusted by everyone. And I'm not limiting it to Apple either. Alibaba, to be fair, is also trusted by a lot of people, and WeChat is trusted by a lot of people. So when those big tech players start moving into the financial services industry, they're moving into the industry with a great deal of trust and a very long base of consumers. And that is an interesting one to watch.
Thank you. In our last few minutes, I wanted to turn to economics. We're in a period with low interest rates and also negative interest rates in some regions, including yours, Veronique. I was wondering, what is the interplay between monetary policy and regulation? How do those two work for you?
Well, I will cite Jean Lemierre this morning saying that monetary policy is not done for the benefits of the banks' profitability, right? So I think that's the first point to say. However, indeed, there can be some unintended consequences of monetary policy, and clearly the risk of some asset bubbles that central bankers are certainly very well aware. What I would say is that the issue is that we have countercyclical measures in the prudential regime, in particular the countercyclical buffer. However, those may not be targeted to specifically those asset bubbles. So my recommendation to the FSB and the G20 would be to maybe rethink the toolkit on macroprudential measures and try to go, first of all, into more targeted measures. For example, is there a bubble on real estate prices, in which case, how can we address that, maybe very specifically rather than through a capital buffer that hits the whole portfolios without being really generating the right behavior, if you like. And second, often those bubbles may not develop into the banking sector, but in the non-bank financial intermediation. And how do we think about macroprudential tools that would apply outside of the banking sector?
that as a former central banker, how do you see that? Do you see a link between the regulation and monetary policy? Or does monetary
yeah.
policy just get set and the regulation should just apply?
Of course, monetary policy is transmitted through the banks. So there is a clear link between the banks and monetary policy, and banks need to be supervised. So that's the official language. That's the logical language. On the other hand, there are conflicts of interest within central banks now, because supervisors have problems with decisions of the colleagues who do monetary policy. Because, of course, I see the logic of negative interest rates. I even see more logic in a negative interest rate than in acquiring massive amounts of government bonds. But I don't see a logic in such a lengthy period of negative interest rates. Negative interest rates will also lose their effect. We are at minus 0.5%, minus 50 basis points in the Eurozone right now. Who believes that if we go from minus 50 basis points to minus 60 basis points, that companies will start investing? I have big problems understanding that, and that's where the conflict of interest starts. That's where the conflict of interest, or don't even start, that's where the conflict of interest materializes. And that's why, these extraordinary measures were meant for short periods of time, because the stimulus effect isn't there forever. The stimulus effect will sort of level off. And that's why there should be and needs to be a Chinese wall within central banks between those folks who look after monetary policy and those folks who look after bank supervision. And it is, I am not a big fan, as I mentioned before, of having many bodies, but having bank supervision and monetary policy in the same institution, in a scenario as we're having right now, may not be the best place. It may be because there are different goals and different demands. Let me stop here, otherwise I'll
Thank you very much. We are out of
get too
time,
far.
but it's been very stimulating. Please join me in thanking my panel.